all we're going to do is take the income that the facility is currently generating, subtract out the current expenses, and now we're going to get an existing net operating income. So really that's cash flow, except you're not including debt service in that calculation. So it's as if you bought a rental house, all cash. What would your cash flow be annually? That's your net operating income. And then we're going to multiply that by a multiple. That's a bad way to describe it. Or we're going to divide it by a cap rate. Generally speaking, storage facilities are going to be worth somewhere between, let's say, in this market, it's tough, but
I'm excited to hear your answer right now, because if you look on LoopNet, you kind of see cap rates everywhere, right?
There's nothing, no market sells at an 8 cap on LoopNet, right?
Right. So generally speaking, when I started in this industry, if we were looking to buy properties at a 10 cap, and it happened with relative frequency, it doesn't anymore. To your point, to find an 8 cap is hard. What an 8 cap means is the property is valued at 12.5 times that net operating income. So you take the NOI, divide by the cap rate, and that will get you a value. Generally speaking, we're trying to buy between 8 and 10 right now if we can. But I will say, especially when we're talking about these extreme value add properties, cap rate falls apart as soon as you do the math, because they're half full, they're a quarter full, and in many instances, you run that formula and all of a sudden they have to pay you to take the property, which we know they're not going to do, right? And so what we do is we look at the stabilized value of the property. What will it generate when we're running it the way it should be run? What will our expected expenses be? Now we have an NOI. We use the cap rate formula based on what we know about that market. It could be anywhere. In the properties I invest in, we're going to sell them between a 7 and an 8.5 cap rate. In larger markets, big cities, it might be a 5 or a 6 cap rate. If Class A properties, multi-story with elevators, like that type of thing. But we're gonna use that to get our basically as stabilized value, and then we're going to reverse engineer. Okay, what can we offer? Oftentimes in the rehabbing world, that's your max allowable offer. You know, it's the after repair value times 70% minus whatever you got to do, you know, your expenses, and you build in that profit margin. We're doing the same thing. I try to get as close to doubling the value of the property as I can.
Do you think the other forces that are at play right now, like inflation and low interest rates, are going to compress those further over the next year?
Oh boy, if I knew the answer to that question, huh? It is a great question and a hard one to answer. I've been, you know, to put it in greater context, I've been hearing for 5 years that the storage industry is past its peak. The reason why that's been said for 5 years and we still don't know if it's true, I think is largely the inflation, right? There's everything costs more than it used to, for better or worse. And I don't know, I don't want to go too far down the rabbit hole. I don't believe that there's a safe way to end that quickly anytime soon. The bottom line is inflation is necessary to keep the stock market and the greater economy healthy. And we need the economy to be healthy so that there's enough people to pay taxes to keep our government funded at the rate that it's spending money. So that's not a commentary politically. It's just a financial truth of what's happening in our world. So I don't see any easing of the forces behind the inflation. And because that, I think prices are probably still going to stay very strong across the board, especially in storage. What I will say is I never, ever want to see anyone buy based on factors that they can't control.